Speaking of the Indian banking system, I recently read one of your recent interviews where you spoke about the fact that the Adani Group had exposed the weakest links of the Indian financial system. But I don't know whether they were alluding to specific banks or insurance companies, but what were you trying to say?
I think this is no secret that if you go back in time, Indian banking and Indian family group companies have been linked at the hip, which is you loan to a family group and you don't do the due diligence that you would have done with an individual company, and not because you're corrupt, but because you assume the family will come through. And I think that's a very dangerous mechanism for lending. So I wasn't talking about any corruption or any inefficiencies per se in the Indian banking system. It's the close relationships between lenders and the businesses that they lend to, which can lead to being sloppy in your lending. So I think that is a weak link in the Indian system. We know it's a weak link. It's led to some Indian banks having loans on their books to family groups that should be written down that haven't been written down yet. And this is a fight that's been going back to the days of Raghurajan at the, when he brought this problem up to the surface. It's not a problem that's gone away. And it's a problem that I think India has to deal with frontally if it wants to become the economic power that it aspires to be.
Do you see this as more of a public sector institution problem or all all across? Because many of these group loans that you're talking about or business group exposures that you're talking about often end up in the hands or the lap of the public sector, whether it's the state-owned banks or the Life Insurance Corporation of India. Do you see a distinction there?
See, this is the problem with banks: is risks and losses are not separable. If State Bank of India goes down, guess what? It's not just State Bank of India going down, it's going to bring down the banking system. And look at Silicon Valley Bank, it's the 16th largest bank in the US. In the largest scheme of things, you're saying, who cares if the 16th largest company goes down? 16th largest technology goes down, you wouldn't even have noticed. 16th largest bank goes down, look at threatening to bring down the entire system. So unfortunately, in banking, there's no such thing as separability. So if the big public sector banks have troubles, guess what? It's everybody's problem.
That is true. But we keep talking about loans and loans going bad and exposure for the banking system. The other thing is what is going on in the ecosystem of digital companies, the new age digital companies in India, where they too are growing, but they don't have recourse to bank debt. They take the money from private equity companies, and now there is a squeeze out there. How do you see that whole crisis playing out? Because the obvious starting point has been a huge amount of job losses in India as these companies curtail operations. But what's the end game in that story?
Well, two things. First is young companies should never borrow money. So not having access to bank debt is a good thing. Banks shouldn't be lending to young companies because what are they going to pay it back with? So it's true you're at the mercy of venture capitalists, which I guess is the version of private equity that plays out here. But come easy, go easy. I mean, these are companies that came out of nowhere to be worth billions of dollars. And these are companies that will lose value. So why do we shed tears about this? This is the nature of the process. In the good times, you raise too much capital. In the bad times, you won't raise very much. It's healthy for the ecosystem, for the weakest of these companies to essentially be shaken out of the system. So I know it's painful in the near term, but I think it's healthier for an ecosystem not to have too much money sloshing around. And in my view, for a decade, we had too much risk capital funding these companies. And what happened in 2022 was a reversal to normalcy. It wasn't some retreat to some bad spot. It was just a reversal to what a normal risk capital market looks like. So I think in a sense, you might be shedding tears for the wrong companies. These young companies that raised too much capital went after traditional companies and regular businesses and ruined them. I mean, nobody shed tears for those disrupted companies. So why are we shedding tears for the disruptors now?
If you like the video, do like, comment, share and subscribe.